Hi, welcome to this video today, which is on the 2nd of July. It's Monday. We're going to be looking at swing trading opportunity in Euro NZD, which we think offers excellent risk to reward. Now, in terms of the strategy, it's very simple. What we want is an elevated price spike. Okay. What we also want is prices to deviated too far away from a mean price or a moving average. And what we also want is to know what smart money is doing. Now, in Euro NZD, speculators are buying, heavily. Smart money commercial hedgers on the COT, which is our favourite backup tool to our technicals, are selling hard. Now, normally when you get big divergence between speculators and commercials, the odds favour a break in favour of the commercials. I think this looks a really attractive setup. Now, in terms of the COT, if you're unfamiliar with it, there is a video link underneath this one where you can learn more about it. It can be used in many different ways for long-term trend following or for swing trading in this instance. Now, what we're going to do is we're going to go and look at the opportunity. And just do keep in mind that when I'm doing my analysis, it is my view as of right now. It can change in line with the market conditions. If you want all our trading techniques, our COT analysis, and also our daily technical analysis of 14 major pairs, you can click on the link beneath this video. Now we're going to go and look at the setup. I'm going to start by looking at the COT net traders data and just explain why I've picked this particular trade out. Then we're going to go and draw some levels of entry, stop and target. Just very quickly on the COT net traders data for this week, so I could just explain why I've picked out this pair, Euro NZD. And just briefly for new viewers, explain how it works. CFTC released this data. They give two groups on the CME, the Chicago Mercantile Exchange, which is a real sort of snapshot of the overall Forex market. It's like a poll, okay? And you have two groups, non-commercials, who are the speculators, commercials, who are the real smart money, the hedgers. Now, statistically over time, the commercials tend to be right about turning points, important turning points in the market. And what you want is the two groups to diverge apart. I'll just show you briefly in a major how it works. Swiss franc, we work it out as a simple ratio. They're bearish by 3.9 to 1. Bearish over bullish bets. Commercials 5.8 to 1 in terms of bullish over bearish bets. So that makes the divergence 9.6. Commercials obviously going against the non-commercial speculators. So that's a potential swing trade setup. Now, we do actually create the crosses from this data. And let's go to the one that we're looking at, Euro NZD. Non-commercial speculators, 3.4 to 1 in terms of longs over shorts, but the commercials, 6.2 to 1 in terms of shorts over longs. That gives a divergence of 9.6 between the groups. We normally like divergences of around 10 or above. The higher the divergence, the bigger the probability is it's going to break in favour of the commercials. And what we can see, just generally in the Euro crosses this week, speculators want to be really long, commercials want to be really short. Now you will notice a bigger divergence of 12.1 in Euro CHF. Why am I not choosing that one? We've done this one in previous videos. It's come down a good, I think, about 300 or 400 pips since entry. It's still an open trade for us. But the turning point in that one has been, this one for me is the best of these. You can go and look at them all. But it's just so attractive in terms of the chart from our perspective. So let's go and take a look at the setup. Right, we're on the Euro New Zealand dollar, and let's just look at this price spike. What we see is a big red candle down, big blue up, double bottom, fairly gentle rise, and then the elevation on the last three candles. You can see if you just draw a quick trajectory line. So there's the gentle elevation, and then when greed takes hold, let's say, there is the acceleration, okay? Now these sorts of moves normally will end, okay? And we've got the commercials as backup. They're not a timing tool. They're just basically giving us clues that, yeah, prices have run too far. And I will stress this point for new viewers. The commercials don't lose any money, so it can overrun them in the short term. They're going to be right longer term, okay? They don't lose any money. We do. We're just using them as backup. Now, in terms of the level I've drawn in, it's obviously chart highs. I'm going to try and aim to get up to there in my view. Just before I talk about levels of getting in, I'm going to do it if we move higher and if we move lower. Spoke about deviation from a mean price. Bollinger Band, easy way to do it. You can see from the width of the bands, okay, how far they are apart. That gives you the volatility here. The green line, 20-day moving average, that will give you the mean price. So we would expect possibly to get back to 169. Obviously, we'll be tracking this trade as it progresses. And I will actually be putting it in the member center as one of the guest pairs, so anyone can go and have a look at it. But let's take two scenarios. One, it goes higher, and one, it doesn't get up to resistance. So let's say we get up to resistance or above it. We'd immediately view that as a potential failed breakout. We'd sell back through the round number. So if it got above there, we'd sell back through 173.80. Put our stop back behind the next round number, well clear of that tail. Okay, so 175.40, something like that. So if we come through one round number on a swing trade, we would normally want a stop back behind the other round number. Then we can see if she runs to the downside. Now, what if she doesn't run on to resistance? Where would you want to sell her? Well, I think there's a good level here because you've got three bodies just broken above and that previous tail. Okay, so if we came through here, which is about 172.60, that would be a sell in our view. You track it as it goes, but to go down towards that 169 level. Okay, where would you put your stop then? You could either go back behind there to be really safe, or just back away from this tail. Okay, so say 173.80, so 120 pips risk. You generate yourself about a 3-to-1 risk reward on the lower entry, 4-to-1 risk reward on the higher entry. You've also, yeah, if you look at indicators, you've got the stochastic, well overbought extreme, RSI turning flat at a chart extreme as well. So we've got that price spike. We know that price spikes generally really tend to fade. I think this one could as well. There's two potential entries there. And then you just have to manage the trade and obviously see if she runs nicely to the downside. But for me, the euro, the commercials are selling it everywhere on the COT. If you look at the weekend, obviously we did Euro USD, Euro JPY. They're long-term trades. Euro USD and Euro JPY have done well for us over the last 2 months, and we've used COT divergence in our trend following trades as well. Here it's just a swing trade, should get a result right or wrong pretty quickly, which is what we like. And if it's wrong, the risk for us against the reward is worth taking. So I think it looks a good trade setup. So we'll see how it goes. Thank you very much for watching me as per usual. Take care and have a good day.